You are considering a new product launch. The project will cost $1.4 million and have a 4-year life and no salvage value. Depreciation is straight line to zero. Sales are projected at 180 units per year. Price per unit will be 16,000. Variable cost will be 9,800, and a fixed cost will be 430,000 per year. The required return on the project is 12%, and the relevant tax rate is 35%. Based on your experience, do you think the unit sales, variable cost, and fixed cost projections given here are probably accurate to within plus minus 10%? What are the upper and lower bounds for these projections? What is the best case NPV? What are the best and worst case scenarios? So this is asking the same thing. Evaluate the sensitivity of your best case NPV to changes in fixed costs. What is the cash break-even, and then what is the accounting break-even? Okay, so what we need to do is we need to create a bit of a timeline so we know what it would look like. So at the very beginning, we are at $1,400,000 for the equipment. We then have 4 years that we can use it. And in each year, we have to determine what our cash flow is and then bring it into a net present value calculation to today to see if it makes sense using our rate of return. So to determine what it is that our final cash at the end, we have to do an operational cash flow schedule. Now it's asking us to do our best case and our worst case. What we want to do is best case, worst case, and we're going to do what's called our base case. Base meaning what we expect. So all of these expectations will be our base, and then our worst case will be, well, the bottom half of this, 10%. The best case will be the top half of this, 10%, and then the base case will be in the middle. So what does that look like? Things that are affected by this plus minus 10% are unit sales, variable cost, and fixed cost. Those three things will change. So we'll start with and I'm going to do my base case over here because we're just going to need to refer to it in a bit. So I'm going to start with my sales. And here will be my worst case, best case, and base case. So our sales quantity in our base case was projected to have 180 sales, but our quantity is affected by our best and worst case. So in a best case, we're ahead of 10% more, which is 198. In our worst case, we have 10% less, which is going to be 162. So 10% more of this is best, 10% less is worst, and our base is 180. Our sales price is not affected here, so it's going to be the same across all of them, which is 16,000. And that gets us to our total revenue of $2,592,000. So this multiplied by this, 3,168,000 and 2,880,000. So again, our base case being the middle one, our best case being that the best case we can expect to bring this much money in sales, and our worst case would be this much. So now for each sale, we have to determine what the variable cost is. Now variable cost will be affected here, so we've already got the unit sale one. The variable cost will be affected by the 10% best case, worst case. So we need to determine our variable cost per unit. And in our base, it's what's stated here, which is 9,800. At a best case, it's 10% less, which is 8,820. And at a worst case, it's 10% more, because this is the cost to the company, which is 10,780. Now this is all per unit. So to get our total variable cost, we need to multiply our sales by our variable cost. So for 162 sales at 10,780, we have 1,746,360. 198 times 8820 is going to be 198 times 8820 is also 1,746,360. 360. And here we have 1,764,000. So these can be reduced from our revenue. We get our gross profit. So 2,592,000 minus this, 845,640. $1,421,640, 686,000. Oops, right. 1,100,000. And now we can go to our fixed cost. Our fixed cost being affected here by the best and worst case scenario. So our fixed cost in our base would be 430,000 here as it's listed. For our best case is 10% less than 430, so it's 387,000. And for our worst case, it's 10% higher, so we get 473,000. We get a total of 372,640 for our earnings before interest and taxes. Okay, so we have our EBIT. So this is the amount of money that's going to flow to the organization each year based on the purchase. So what we can do is we can determine the net present value for each of them with our calculator. So our net present value for the worst case, go to cash flows, Our opening cash flow would be negative 1.4, enter. After that, our cash flow each year for 4 years is going to be 372,640, and we're going to have 4 for the frequency. If we go to our NPV, our required return on the project is 12%, and our net present value is negative 268,162. So we have to be aware that at our worst case, we would have a negative net present value. We wouldn't go through with it. At our best case, if we go back to our cash flows and change this to 1034640 and compute, we get a very impressive NPV of 1742563. So we would definitely go forward with our best case. And our base case, again, we go back to our cash flow, change our cash flow to 686, and compute our new net present value. We get a 683,621. So we would pursue it with this net present value. So now we can see our net present value between base, best, and worst. The next question asks, what is the sensitivity of your base case net present value to changes in the fixed costs? Well, what does a change in the fixed cost do? We can determine just by doing $1 change to the fixed cost. So what we can do is add $1 each year. Now if we had an increase or a decrease, so we'll do a decrease in dollar each year, or sorry, pardon me, an increase in $1. What this actually means is that we're not out $1 because we are going to save 35 cents in taxes. So what this actually is 0.65, 0.65, 0.65, and 0.65. Go to our cash flow, enter 0.65, enter 4 times, net present value, compute. And an increase of $1 to our fixed costs is going to change our net present value 1.97. So this multiplier, if you were to add $10,000 of fixed cost, you'd be adding 19,700. If you were to reduce fixed cost, you'd be reducing 19,700 to your net present value. Now the next part asks us for our cash break-even and then our accounting break-even. So what is the difference between cash break-even and accounting break-even? Well, break-even is the point that you pay off. So for the output of the project, this would be you pay off your fixed costs. So basically each year you make $0. That's your break-even point. How many do I need to sell this year to make $0? Now cash means forget about any non-cash expenses, only worry about how much to make my cash go to 0. Whereas accounting wants to know even those expenses that are non-cash based. So we'll start with the break-even for cash level. Well, we need to pay off anything that we produce. We'll do it beside our base case. Anything that we produce, well, we get $16,000, but we always have to pay $9,800. So 16,000 minus 9,800 means every one that we produce and sell, we get $6,200 to put towards the rest of our expenses. Because you have to pay your variable first. If we didn't make the sale, we wouldn't have a variable cost. If we do make the sale, we have the variable cost. And then, so what do we have to pay off? Well, we have $430,000 of fixed costs, and we're going to pay it off $6,200 at a time with product sales. And we get 69.35 but we can't sell 0.35, so it's 70 units. So our break even on a cash break even is 70 units. Now, what do we need to do for our D? We have to include our accounting break even. So we have the same 430,000 we have to pay off, but we also have depreciation. Now depreciation has no salvage value in a straight line for 4 years. So it cost us 1,400,000. We got 0 salvage and we're gonna depreciate over 4 years. That means we have to pay off 350,000 each year in depreciation to break even, plus the 430 that we are always going to incur with costs. So 430. So we now have to make 780,000 back. Well, to do that, we're going to divide it by the $6,200 that we make per sale. And we have 125.8, which is 126 units to break even.